Welcome to the HMO Success Podcast. I'm your host, Wendy Whitaker-Large, and I'm here to help you create a profitable HMO portfolio. Whether you're a brand new investor or you've been at it for a number of years, my podcast is here to help you make the most from your business, whether that is starting up, scaling, or systemizing. Please hit the subscribe button to make sure you never miss an episode. And if you've got an awe-inspiring project, an inspirational investing story, or a unique approach to HMOs, I'd love to hear from you. Good evening, everybody. I'm delighted this evening to have a very special guest on. And the reason why I think what you're going to hear tonight is very special is because it comes from somebody who's got a lot of experience in dealing with the whole area that perhaps we as landlords don't always want to think about, but it's really important. And that is a 3-letter word, and it's called tax. And tonight, our very, very special guest is Neil Ryder from Aston Lee, and he is going to talk to you about how to mitigate tax. In fact, he's not just going to talk to you, but I'm going to ask him questions about it. I'm going to interrogate him, no less, and ask him about how he can help you. Because as we know, tax is one of the biggest costs to investing. And if you don't get this right, you can find that your investing just does not give you the returns that you want it to or that you designed it to. And mitigating tax is a critical skill for any investor because it enables you to keep more of what you made. And who doesn't like the idea of that? So, Neil, thank you very, very much indeed for joining me tonight. Really, really pleased to have you on. So, Neil, just tell us a little bit about your background and how you got involved in this whole industry, this whole area.
How did I get involved? I've been involved in the property sector for probably more years than I care to want to remember. And my background, I am a property investor myself. I mean, we have a small portfolio, and I spent a lot of my working life dealing with big organisations and dealing with large-scale organisational change. And I seem to spend a lot of time on aeroplanes, flying backwards and forwards, primarily to Northern Ireland, to Belfast. And one of our particular projects came to an end, and I decided that I didn't want to spend this time away from home, away from the family. So I started to look at working with small, medium-sized enterprises and helping the owners there think about the journey that they're going on from where they are to where they want to be. And usually where they want to be is out of the business. They're thinking about how they might exit. And for some reason, I think it was maybe because I was involved in property myself, that I started to pick up a lot of property investor type businesses. And one of the things that became very, very clear at that particular point was that they got this very, very anti-feeling with regards to what we would call pensions. And they would avoid it. So they were looking to ensure that they could keep control of their money. They didn't like the idea of using a pension, which would see them put money in it, but then lose control of it. And through the work that I'd done on change, and I already knew about the small self-administered schemes, SAS pensions, and we started talking to them about these as options going forward. And one of the things about making pension contributions is that it has quite a good tax advantage. That if you're working through a limited company and you're making pension contributions, then it's an allowable business expense. And as an allowable business expense, it's reducing your profit and reducing the amount of corporation tax that you pay. But it's only one particular area. It's only the beginning of the journey as far as tax planning is concerned. And something like a SAS pension is only really relevant if you're working through a limited company. Yet something like 78% of all property investment or rental properties are owned in people's own names. So pensions are not necessarily the best tax planning vehicle for them. And it was through that involvement that I started to get more and more involved in the wider aspects of tax planning within, the property landlord type environment. And over time, I built up a big network, a big group of people that I was working with, that were able to provide a wide range of technical tax advice and technical tax solutions for this particular sector. So I think it started, Wendy, from an interest in property, from my own point of view, and it was also using skills that I'd acquired, consultancy skills that I'd acquired through working in a big corporate world, and really felt that there was something that we could offer to this property tax community. I mean, if you think about tax planning and wealth planning in general, then there are a lot of advisors out there, financial advisors out there, but they don't really deal with some of the tax issues that the property investors are facing. They're okay when it comes to dealing with regulated products, and the property area is a very, very specialized area. It faces tax from so many different angles. It doesn't matter whether you're investing in your own name or investing through a limited company. Then the tax pressures that you face are coming from all kinds of different directions.
I think that's so incredibly true. And actually, I think it shows real wisdom and insight to recognise that the property community, the property investing community, needs guidance, specialist guidance that is comes from a place of experience and knowledge for the first point, but also because you've obviously got experience as an investor yourself, but also recognises the incredible legislative and regulative environment that we're working in. So a lot of landlords are quite cautious and careful. Yes, they're investors, but they want to do it right as well. But yet you're absolutely right that unless you get specialist property tax advice, the likelihood is that you might get some advice that actually is not quite right for your circumstances, because you're speaking to somebody who's more of a generalist and perhaps doesn't understand some of the nuances that property creates.
Yeah.
So,
and I think you've also got to be careful, Wendy, that that one of the things that we've seen within the property sector, and you see in not just tax areas, but what is badged as advice isn't necessarily advice. It's somebody who's got a particular interest, a particular let's call it a product that they've developed, and they want to push that within the community. And rather than giving you the tax guidance that you need by getting underneath what it is that you're doing, what it is that you're trying to achieve, what your personal circumstances are, they're very, very much solution driven. There is something that we've got. There's a tool that we've developed. There's a solution that we've come across, and that's the answer to everything. And I think that you've got to be very, very careful in working with advisors and working with specialists to ensure that they take the time to really get underneath you, get to understand you, get to understand your personal circumstances, get to understand what it is that you're trying to achieve. And then they're considering all of the options and giving you the information so that you can make the informed decision. So
yes, that's very, very important. Vital. It is, because you're absolutely right that sometimes you just get the impression that somebody wants to sell you something, and actually that might be right for you, but it might not be right for you. And if you haven't gone through that process of due diligence and figuring what you need, and the other person assessing what you need, then it could be a square peg in a round hole solution, and it's not really right for you, but you may spend a lot of money getting to that point.
Yeah, and without understanding, without having a real good picture of what it is that an individual is trying to achieve by being involved in property, then by giving them a packaged solution, it might actually solve the problem that you've got today, but it could cause a problem tomorrow. So, and I think that's what you've got to be very, very careful about, is making sure that anything that you do, any strategies that you're trying to develop, really do consider both the short, the medium, and the long term.
Well, we'll no doubt come back to that, but I want to kind of ask you, where are we today? There are lots of pressures on landlords. There's lots of threats to investing. Tell me, in your view, in the light of, I suppose, another change that we've seen today, another interest rate rise, where are we today, and what are the challenges that landlords are grappling with?
Where we are today, I mean, we are, whether we like it or not, we're in a high tax regime. That the cost of COVID has got to be recovered from somewhere, and as a result of that, we've seen over the past 6 months certainly move to a much higher tax regime. And as a result of that, we're also in a high interest rate regime. Yes, we've seen interest rates go up again today, but not only that, in Scotland, I mean, the budget in Scotland has seen, their second property rate tax, their equivalent of SDLT in England and Wales, has gone up from 4% to 6% on second properties. So we're seeing it, across the country, and this, in a way, is very, very much an attack on profits. So we are in a situation where, as landlords, as property investors, we're being attacked on a number of different fronts. And then there was something that I read that the Institute of Fiscal Studies, they've put out a paper today where they're saying that people who inherit pensions shouldn't inherit them free of tax. Now they're saying that they should be subject to income. People who receive them should be subject to income tax, and the person whose pension it should be included in their estate for IHT purposes. So there's all these kinds of different attacks that are going on. Okay, that's the Institute of Fiscal Studies. It's not the government looking at something like that, but will the government actually listen to these kinds of bodies? And I think that where we are is that we have a problem. That with for property investors, property tax is so complex. We've got personal taxation, so we're talking about income tax, capital gains tax, inheritance tax. We've got corporation tax, which is and dividend tax, and then we've got property tax as well, SDLT and the equivalent in Scotland. And then there's all the different reliefs that we can claim. Things like capital allowances. If we're using things like furnished holiday lets, then we've got the capital allowances that we can deal with, and things like incorporation relief. And a lot of these are not always understood, and sometimes misunderstood. And I think it's trying to provide, the real information in this very, very complex environment.
Now, that's a really important point, because what you said earlier, which is that it's short term, medium term, and long term. One of the challenges, I also think, is that we can't predict what changes are going to be up ahead. And I think for some people who might be trying to plan medium to long term, one of the stumbling blocks is to think, well, what if things change? For example, we've seen today the Scottish government change their rates of higher rate tax on higher income earners. Yeah. So they brought it down from £150,000 to £125,000. A penny more in the pound is going to be taxed if you're earning over a certain limit, yeah, etc. So you might have planned this year, if you're a business owner, to have a certain amount of turnover, which would lead to a predictable amount of profit, which would then lead you to having a certain amount of maybe salary, dividends, etc., earnings. And now you're saying to yourself, well, there's no point doing that. There's no point now me earning £140,000, because that extra over above £125,000, that's another 15,000, is just going to be taxed at such a high amount, there's no point me trying to even earn it. I'll just take another 3 weeks off in the summer and not work.
Right.
And so I think there's all these kind of psychological drivers in the market as well, which contribute to the way people, I suppose, plan or don't plan. But that's my take on it. What's your response to that, Neil?
I think what you've just said, though, Wendy, is really about people then not fully understanding what their real situation is and what reliefs are available to them and what structures they can use to actually operate their business. For example, I mean, most people, most property investors that when we initially have a conversation with them are usually only handling or dealing in running their property business in one of two ways. They're either doing it in their own name or they're doing it in a limited company. Okay, and they understand the tax implications of doing it in their own name, and they understand the tax implications of doing it through a limited company. But doing it through a limited company also then feeds back into the personal tax situation. But what they're not taking the opportunity to do is to talk to, I suppose, somebody like me, who spend a lot of time and has a team of chartered tax advisors that are looking at these kinds of situations and fully understand the tax legislation. We call them tax maniacs. We keep them in a cupboard down the end of the corridor, because they like to read tax manuals. They're not always that good. I mean, their interpersonal skills inside the team are okay, but I wouldn't feel really that comfortable and confident of letting them loose with real clients. But these are the experts that we have on tap that we can go to, that we can go pick their brains and we can give them these kinds of situations, and we can say to them, well, look, these people, tax has gone up by a penny. What should we be doing with this? And the kind of answers that we get back from them is, well, you're probably not using the right structure to run your business. And there are other structures that we can use. That there are the structures that already exist have sets of rules around them. But the average guy in the street doesn't have the time or the interest to actually go into the complexities of what these tax rules are and what they genuinely allow us to do. Now, there's one basic rule that we will always follow when it comes to tax planning, and that is any tax planning that we do follows both the letter of the law and the spirit of the law, and that's absolutely vital, because if HMRC are going to challenge you, then they will challenge you on both the letter of the law and the spirit of the law. What do we mean by that? First of all, are you doing is what you are doing enshrined in UK legislation? Right? Does it follow the letter of the law? If it follows the letter of the law, absolutely fine. But then they'll also ask, well, does it follow the spirit of the law? Are you using the law in the way that it was intended? And I think that's absolutely vital. And, we've seen cases, I mean, people like Jimmy Carr, with the tax schemes that he got involved with. Now, they are schemes. And when we talk about schemes, what we usually see is different pieces of legislation trying to be pushed together in order to develop a solution, which means that people avoid paying tax. Now, one of the problems that you get when you push different pieces of legislation together is that they don't actually follow the spirit of the law. You're using something in the way that it was not intended. So one of the basic, the key principle that we will always follow is that any tax planning that we will do for a client has to comply with both the spirit of the law and the letter of the law. And if we can do that, then we know that we're not going to get challenged somewhere down the line. So when we look, when our chartered tax advisors are looking at a problem, they understand the letter and the spirit of the law, and they will suggest things and give us ideas and show us how we can use different kinds of structures to achieve different things. So, for example, I mean, if you take, say, something like a SAS pension. Now, SAS pensions were introduced back in 1970s, mid 1970s.
Wow, I didn't realise that. I thought it was much later than that when SAS pensions came in.
SAS pensions,
right? Interesting.
Were introduced in I think it was 1974, but it was mid 70s. Property investment, as we know it today, did not exist. Okay, and the SAS pensions were introduced because of the government's concern that small, medium-sized business owners, okay, at the time, were not contributing to pensions. And what they were doing was sitting on large amounts of cash, post-tax profits. And when they were asked why, well, it was rainy day money. You know, what are you going to do with it? Don't know. But it's there just in case we need it. It's my pot for the future. And what the government did then was, in order to encourage them to invest into pensions, they created this hybrid pension called a SAS, Small Self-Administered Scheme, whereby you put the money into a pension fund, but you retain control of it. You know, you decided what you invested it into, but they also gave you the ability to loan back up to 50% of the value of the fund back into the company for working capital. Now, because again, 1970s, what we were talking about there was small manufacturing businesses, distribution businesses, you know, little warehouses, things like this. So, and that was why SAS was introduced. Now, why?
I see, and I suppose that's also why you have to be a limited company director to have a SAS, because it's tied up with that status, isn't it, of running a limited company?
Well, I mean, a SAS has to be associated with a limited company.
Right.
You know,
okay.
It is it's an occupational pension.
Yeah.
It's defined as an occupational pension, and to be an occupational pension, it has to be sponsored by a limited company.
Okay.
The members of the SAS do not necessarily have to be directors of the company.
Yeah, that's true.
They can be employees. So, wind forward, you know, to the late 1990s, when we saw the introduction of buy-to-let mortgages, and buy-to-let mortgages were introduced as a tax concession for mom and dad to buy another property and rent it out. You know, and it was and buy-to-let at the time was seen very, very much as almost like I mean, the Americans would call it a ma and pa business. You know, I call it a little hobby business. It was just a little hobby business. But you know, but over time we saw, you know, the real rapid growth in property investment, and people were using legislation which was intended as a little mom and dad business to grow a massive, great big business by having property in their own name, rental income, offsetting mortgage interest. And then as property prices increased, remortgaging those properties, taking the increased equity out, but not paying any tax on it. Okay. And what did the government do at that particular point? They put the handbrake on it, Section 24, which said Section 24, you know, the route that people took then was to incorporate, or to start running their property portfolios through a limited company. And then we saw this, the growth of the limited company, and then somebody spotted limited company, SAS, made the connection, and suddenly we see a rapid involvement of SAS pensions linked to property investment companies. You know, and what we now started to see was probably pension funds being used in a way that wasn't quite intended. You know, it wasn't quite intended to be used, you know, for property investment. You know, so we need to be very, very careful in the way that SASs are used and the way that the things are invested that way. But the reason I got to this particular point is that pensions are a great tax route, because if you make pension contributions, then the company, if the company is making contributions on your behalf, they're allowable business expenses, they reduce your profit, and they reduce your amount of corporation tax. But if you put money into a pension to a degree, you lose a little bit of control over it. But there are other pension wrappers apart from SAS that you can use that will enable you to invest directly into property. And that can be residential property and corporate property. And all of this is enshrined in UK legislation, Wendy. But we seem to pick up little bits, and they've almost become flavours of the month. And then everybody wants to jump on that particular bandwagon.
So it sounds like from what you've said, Neil, that there are certain structures that, depending on your own perspective, your own goals, your own, the purpose. The purpose seems to be inextricably linked. That one size does not fit all in this environment, and to find the right structure, you and your team would very carefully look at somebody's portfolio, ask them a number of questions about what they want to try and achieve, let's say in the short, medium and long term, in order to be able to make some recommendations. And because you've got such a wide remit or a wide understanding of those different structures, whether it's a SAS, an LLP or something else, you're able to say to that person, given your particular goals, your particular ambitions for your business, whether it's to retire to Mallorca, or it's to continue to build your property portfolio, or it's whatever it is, you're able to advise somebody best as to how to create a structure that will, I suppose, grow with them or adapt with them, but also allow them to remain compliant, because I think that's the other massive side of the coin, isn't it? That's the other very important area.
You have to remain compliant. And I think that, the property portfolio, is probably always a starting point. So what sits in this portfolio? How is it owned? But the other important piece is the individuals that are involved in that portfolio. What is the motivation? Why are you doing this? What is it that you're trying to achieve? When you're not here, what do you want to happen to this portfolio? Is it just going to disappear? Does it go off in a puff of smoke? Or is it something that you want to pass on to other generations? How do you want to pass that on? And are you looking to pass it on during your lifetime or post your lifetime? And then without understanding all of that, then you can't really do any tax planning. You've got to really get into, and I suppose it's almost like we've got to stand in your shoes. We really got to understand what's going on, and work on something that is flexible enough to cope with change. So if legislation changes, then what does it do to this particular structure? Does this particular does the operating structure become obsolete, or can it actually adapt as well? And I think that's why that there's no single answer. That a lot of the solutions that we have with our clients involve a number of different things. So it isn't just a pension. It's not just incorporation. It's a combination of a number of things that will deliver the solution as over time, and as they go through their own personal life cycle.
And I think that's really important, actually. And you touched on something there that, of course, was the reason why we connected in the first place, because I was looking at our inheritance tax issue and very concerned that my 4 boys would have a total nightmare one day when I die, partly because of course they've lost their wonderful mother, but aside from that, of course, and of course when Andy dies as well. But I suppose maybe it's an age thing, frankly, but you do come to the point in your life where you think, actually, if something did happen to the both of us, the boys are going to be landed with a very big inheritance tax bill unless we can do something about it. So we started to explore trusts, we started to explore all sorts of different mechanisms, and of course came to you, and we're very pleased to be working with you and your team Neil, because you have given us a very, very good solution to our particular problems and our particular challenge, which was the inheritance tax. But actually, the solution you've proposed for us is going to do so much more than just that, which is, it's very special. Actually, I really feel absolutely excited and thrilled to know that we have, in working with you've been able to present us with something which is going to tick far more boxes than perhaps we even realized it could tick.
Yeah.
But your worldview, your perspective is to be able to see how these structures can eliminate other issues that you perhaps aren't thinking about immediately, but they could happen further down the line.
Yeah. And I think that what you've described there, I mean, is we're not a transactional company, right? I mean, if we were a transactional business, then, if you came to us to deal with legacy, then we deal with legacy. Well, that's what you asked us to deal with. That's we've done that. Our approach is very, very much about trying to provide a holistic solution. We want to understand the whole thing. Okay, doesn't suit some people. Some people want a transactional solution, and if they want that, then great. We can point you to transactional people, but it is very, very much about a relationship. We want to work with our clients. I suppose we almost want to be almost like a silent partner, not benefiting from what they do within their own business, but being this somewhere in the background and having conversations at various points, bringing new ideas that, okay, things have changed. We need to tweak what we've done. And if we add this little bit on, then it will give you another avenue that you can work through. And I think it's that holistic approach that makes us that little bit different.
I would agree. I mean, I certainly have found that working with you up to this point has, you've never shied away from answering all the many questions that we've had, and answering them in full and to our full satisfaction. And I think that to me, it has demonstrated, Neil, how committed you are to, and not only ensuring that we as potential clients are happy, but also that you've really thought through what we're looking to achieve. And that approach is, of course, not what many people get. And you're absolutely right that you could easily go to a sort of high street tax advisor and say, oh, I'm worried about inheritance tax, and they could say, well, let's have a look at your estate. And then they might say, right, we think you should put this in trust, we should do this with this, you should sell some of your properties, because otherwise you're going to be over the £1 million level and it's going to be terrible for you. Yeah. And that person goes away thinking, but I don't want to sell, I want to keep, and I believe in property investing, and really I want to bring my children into the business when they're a bit older. And they've got all these other thoughts going on, the what ifs and the buts, but maybe the tax person hasn't asked the right questions, or hasn't stimulated that person's thinking, or been open enough to explore those other areas of thought, which are incredibly valuable and necessary before you can just simply say, oh yes, what you need is an interest in possession trust to be set up for you. Yeah. Because it's just not as simple as that, is it?
No, it's not as simple as that. And we, and there's routes that people are encouraged to go down where they're given, they understand their current, the people will take the time to understand what their current situation is, and they'll just jump them to a final solution. They won't really help them to understand what's going on in the middle, and why we are doing these bits in the middle, and what the tax advantages are of doing these things in the middle. Because sometimes the bit in the middle is actually where you want to stay, and it's what you put around it then that makes it so tax efficient.
So Neil, you've actually got a company called Property Tax 360 and also Aston Lee. Tell me about what's the difference between these two businesses?
Well, in the new year, then Aston Lee will be rebranded completely as Property Tax 360.
Okay, fine,
right.
Fine. So you're part of Property Tax 360, and that's how in 2023 we will get to know you.
Yeah, Property Tax 360 is the brand that you will see. We have a group on LinkedIn. We've got over I've actually got their page open now. We've got 321 members in the LinkedIn group called Property Tax 360, and and that group is very, very much about property tax. It's about property. It's about property tax, and we post regularly in there of things that are relevant or that we think are relevant to the members. We have a website. We've got the Property Tax 360 website, and I think that the clue about what we do is in that name. Okay, it's property tax, but it's 360. It's all encompassing. We don't just look one particular way. We're not just saying, well, we think this particular model is a model that everybody should follow. We want to understand your business all the way around. And I remember the conversation. I mean, you came to us as an introduction from a legacy practitioner, right? Because he recognised that he needed, you needed to deal with your property first of all before you could deal with the will issues. And when I had the conversation with this particular gentleman, I sort of said, well, how big a portfolio have they got? And it was like, oh, they've got about 9 properties. Because that's what you told him.
I don't think I had.
Right?
I don't think I said it was about 9.
But when we dug into it, but I can remember the conversations that we had, when it was okay, tell me about the portfolio. Fill in this spreadsheet for me, Wendy. And then these properties and these little things, kept sort of dropping out. And it's this, and I think it's almost this the questioning technique, the relationship that we can build with an individual. That, well, let's just take time. Let's just do this. Let's just not rush into it. Don't accept what this. I suppose this is letting the cat out of the bag now. Don't just accept what the client tells you. Because they don't always tell you everything.
Well, sometimes also they forget.
Yeah, just keep.
Suddenly you realise, oh yeah, actually we've got 2 others over there.
Yeah, we got. But just keep the conversation going, and leave it on an open basis. And I think a lot of that approach comes from my corporate background, in working in large organisations and trying to get underneath what's going on in the business.
Yeah.
So it isn't, you've got to get beyond what people want to tell you. You've got to get to the point of also getting them to tell you about the things that they don't really want to tell you, about the things that they're maybe not done quite right. That they're and it's just having that, spending the time with the client, being available, that makes a big difference.
So let's say somebody comes to you and they say, listen, I've got a few properties in my own name. Maybe they started investing, let's say 2000 and I don't know, 9, 10, for example, or maybe a little bit later than that, after the property crash, but before Section 24. They've got a few properties in their own name. Then Section 24 comes along and they realised from their own education that they can only invest in a limited company. So they've got a few properties in a limited company. Maybe they have also thought about a SAS. They've also thought about, inheritance for their own children. And there might be they might have another business, for example. They might have another profitable business, and they might also be working part-time.
Yeah.
So
okay, thanks, Wendy. The worst possible situation.
Yeah, exactly, that's right. How would you deal with that, Neil? No. But I would imagine when you have that kind of a jigsaw, you're almost got to put these pieces together through conversation and dialogue and a bit of due diligence planning with the client, don't you?
Yeah, no, and I think what you've done, what you've described, and and you use the word jigsaw, and it is a jigsaw. We've got to get. We don't have the box with the picture on it. What you've got is you've got all the pieces, but you're not disclosing those pieces to us. So we're trying to build a picture by getting you to give us the pieces. And because we don't know, we don't even, and strangely enough, the pieces that we have in this jigsaw puzzle, it doesn't have a board around it. Right? So what we're trying to construct is we're trying to get a view as to where we are. And 9 times out of 10, we'll probably only get initially about 80% of the information and the image. And then it's in subsequent meetings, and it comes over time. Then the other little bits start to come out. And I think that we have to spend the time with the client first of all, that to just get to understand, to suggest things. And I think that by suggesting routes that they might take, then you start to find out whether they're comfortable with this or they're not comfortable with it. But when they're working on the suggestions that you're giving them, more information starts to come out. And then you start to get a bigger picture, and we work very much on the basis that until we understand the client, until we're really comfortable that we understand where they are, what they've got, what they're trying to achieve, then we're not really doing any work for them. Our structures, our charging structure, until we actually feel that we know where we are and where we're going, and that we've agreed some kind of outline structure to go forward, then we're not going to actually charge a client anything.
Yes.
So it's because we don't know whether we can provide something.
Well, I think one of the things that I also became aware of was, as a property investor, I was mainly thinking about my portfolio of 9 properties. Oh, life would be so simple. I could actually count them on 2 hands.
Yeah.
But what I had forgotten, of course, in my whole kind of calculation, if you like, was our personal property, because that goes into your estate when you die. And the relationship that Andy and I have in terms of our ownership of the property, whether we're tenants in common or shared tenants. Joint tenants, that's right. And the importance of planning for that as well, because of potential care fees and et cetera. So there are lots of other elements that at the time you think you're just kind of, somebody might come to you because they've got a portfolio and they want to get the best structure to enable them to be the most tax efficient, legally, of course, as well. We're not talking about avoiding tax that is absolutely due, but we're talking about being efficient and being able to continue to develop and deliver housing for people, which is where I come from. This is about a reason why I do it, which is more than just making money. It's actually about providing something that's valuable and valid and valued in the economy. But yeah, I think when you suddenly start thinking, oh yeah, actually also there's this, and oh yes, of course there's that, and oh yes, there's this and there's that.
and it does take time. And one of the things that when we work with a client, one of the things that we see with people that come to us, some people have already done some tax planning, right? But it's not necessarily that effective. It's situational. It deals with, they've done tax planning to deal with a particular situation. They might have part of their portfolio in their own name, and they might have some of it in a limited company, and they've tried to do a bit of this and do a bit of that, and it's just disjointed. It doesn't. It deals with that problem and it deals with that problem, but it doesn't give them an overarching approach structure that they can go forward with.
Yes,
and I think that's quite important. One of the things that also surprises us when we're talking to clients, that with some clients it's particularly important where they're employees and they've got a portfolio, might be in their own name. Then we need to understand their personal tax position. And one of the things that we'll ask to see is the last SA 302, the self-assessment return that they've given to sent to HMRC. The number of times that we find errors on those, right?
Wow,
And not,
really?
yeah, and not errors, and it's not because they've done the self-assessment returns themselves. It's because they've been done by third-party bodies, not necessarily accountants, but they've been done, and there are errors in the SA 302s.
Wow. So that in itself is quite poignant, isn't it? If you're seeing that and you realise that people are paying too much tax.
Or not necessarily too much tax, but not enough tax.
Oh, okay.
Right.
Yes.
So there are errors on those. And I mean, and the problem you've got is the revenue are so far behind in checking SA 302s and checking self-assessment that they may not get around to checking a self-assessment form for 2 to 3 years. Yes. So you could finish up with a problem, further down the line.
Yes.
And also, we also see and get approached by people who've got rental properties and for some reason have not actually declared them to HMRC. Right. There was one individual who we've looked at quite recently, and he's not declared rental income for 7 years. Right. but the revenue, no.
Okay.
The revenue, HMRC know an awful lot about us.
Yes.
They know a lot more than we think they do. Because they have access to all kinds of information, and they get involved in campaigns, and they do what they call nudge letters. And this particular gentleman had received a nudge letter from HMRC saying that we think you might have rental property. We think you need to do a declaration, and there is a scheme that they call the Let Property campaign, where you can go on and do a disclosure. But again, if people get nudge letters, then they should always get advice before they respond to those nudge letters. But they have got very, very long arms. I mean, if you've got a rental property and you're working through an agency and there's a deposit been paid, then that deposit has been registered somewhere. The revenue can go and access that information to see where the deposits are. And then they will check that information against SA 302s, right? So when they send you a nudge letter, they know you've got.
Yes, they've made a connection somewhere.
They've made a big connection, and they know how long you've had it. And the deposit will also tell them what the roughly what the rental income is.
And of course, you've got the land registry. That's an open database.
Yeah.
So lots of ways.
They know an awful lot about you. And I think that's providing and I think that's why it makes it very, very important to make sure that that any planning that you do complies with both the letter of the law and the spirit of the law.
Now, Neil, I think one of the things that people who'll be listening and watching this tonight will be thinking is, well, so what? They want to know what difference does it make to have good tax planning, and tax planning for people like yourselves who are extremely experienced, knowledgeable, and have got a team of specialists upon whom you can draw to get absolute bang up to date information and also legally compliant structures. What results does it really have in people's lives? If somebody's sitting thinking, well, I don't know if this is going to help me, what can you do that could help them? Can you give us some figures? Can you give us some case studies?
That's the difficult bit, because it really does depend on an individual situation. But we're looking at a case with a client at the moment, and he's working through his portfolio is being run exclusively through a limited company. Okay, so where we are now, or really what we've got to start thinking about, is where we're going to be in the next tax year from April 23, when we see corporation tax increasing to 25%. Now, what some people have misunderstood is how that tax rate is going to impact property investors. So we know that corporation tax is going to be 19% on profits up to 50,000, and it's going to be 25% on profits in excess of 250,000. And then there is this marginal relief that sits in the middle, a sliding scale that sits in the middle. But that only applies to trading companies. Right? So only trading companies will benefit from 19% corporation tax. If you are an investment company, and an investment company includes companies that buy and hold properties for rent, and their income is from rental income, that's an investment company. And all profits there will be taxed at 25%. Right?
Yes.
So that's what people need to understand, first of all. And there's a lot of misinformation out there about this. And the number of people that we get into discussions with, I won't use arguments, discussions with on social media, who think we're absolute lunatics and don't know what we're talking about, when we tell them that no, you're wrong. You will be paying 25% corporation tax next year. So that's a big challenge. But then if you're running through a limited company, what you then got to face up to now is that the tax-free allowance on dividend income has been halved. That's been cut down, and dividend income is we have to pay it. So again, now we got to think then about how we're going to take that income. Are we going to take that income as salary and dividends, and how do we work that through? And what we then see is people thinking, well, what I need to do is I'll have a limited company that will do my investments. So it will hold my rental portfolio. And because I want to do some flips as well, I have another limited company that does flips. Now, if you're flipping, then that is a trading company, because you're buying stock, you're doing something to it, and then selling it on. And the revenue will quite happily accept that is a trading company. Don't have any problems with that at all. But now we've got two companies that are being taxed differently, where I want to take money from in some way,
or maybe move between the two companies. You might want to do that, mightn't you?
So what I'll do is I'll create a holding company that sits above it. Now, accountants love you for doing that.
Yes, don't they just?
Because now we've got 3 sets of compliance fees to pay. And so they think it's absolutely brilliant. Well, great. Yeah, do it. We've got this nice structure. But, and again, what we've also got to look at is that what people don't understand is that the corporation tax rate of 19% up to £50,000, right, and then 250 for a 25%, doesn't apply to, if you've got a group structure, it does not apply to each of those companies. If you've got a group structure, and so you've got a group structure and a trading company, then that allowance of £50,000 is split between the two companies. So it's only 19% on £25,000 worth of profit in each of the companies. The investment company will still be taxed at 25%. So, okay, how do we save people money? Well, okay, we're starting to think about, is a pension going to be relevant to you? Okay, so, but that will depend on what it is that they're trying to achieve. So, but it's a conversation and it's an exploration that we have to have. So if we're allowed to make £40,000 of pension contributions a year, or a company can make up to £40,000 in a year, and that will qualify as an allowable business expense. So if your company only makes £40,000 and a pension route is suitable to you, then we can wipe out any corporation tax liability
altogether. Yes. You won't have anything to live on, but you'll have a fantastic pension.
And that's exactly right, Wendy. You won't have anything to live on if you put it into the pensions that you know about. If you put it into a personal pension or you put it into a SAS and you're not of pensionable age, then you've got nothing to live on. But there are other pensions that you can use that will give you access to income pre-retirement. Okay.
Amazing.
So let's think about that. So, and then we've got to think about, well, what other structures might we use? So, you use that complex scenario. I've got portfolio in my own name. I've got a job and everything else. Well, if you've got a property portfolio in your own name, and a lot of landlords have got that, they started off with property in their own name. You've got property in your own name.
Yes.
You've got property in a limited company. So how do we deal with that? Well, there is this thing called a limited liability partnership, and a limited liability partnership, still a little bit of a new kid on the block, didn't exist until 2001, but gives you the ability to operate as a partnership, but with the benefit of limited liability, but enshrined in all the rules around this limited liability partnership. There are a number of significant tax advantages, but most people, most property investors, the only knowledge that they have of LLPs is as a means to get into incorporation. So they've got a property portfolio in their own name, and there's a number of organisations out there that promote what you've got to do to solve the problems of Section 24, to solve all your tax problems, is that you need to incorporate. And the route to incorporation is we go into an LLP for a couple of years, and then after 2 years, we apply for incorporation. And that's it, job done. But there is very, very little understanding of what the real benefits of this LLP that sit in the middle can do. What are the rules around an LLP? What are the tax implications of using an LLP? And it doesn't really matter as to whether you've got a property portfolio in your own name or you've got a limited company. An LLP, using an LLP as well, has got some significant tax advantages. So, for example, if you're using a limited company and you've got profits, in order to get, if that's all you've got, in order to get the money out of that company, you're either going to do it as a salary and or dividends. And both of those involve tax. You've got to pay personal tax.
Yeah.
But if this LLP is structured in the right way, and we fund the partner's capital accounts in the right way, then profits that are sitting in the limited company can be, post-tax profits, can be invested into its partnering LLP. Okay. And that money that's invested into the LLP can then be drawn down from the partner's capital accounts, which is essentially the equity that you've got in your property portfolio. And the equity in your property portfolio is your money. Okay. So when you draw from your partner's capital account, then there is no tax to pay. Okay. The company's paid corporation tax. Okay. So the revenue are quite happy with that. We've invested money into the partnering LLP. But normally the only way that we would get access to equity in our property portfolio is to remortgage.
Or to sell.
But then you've got to pay tax.
Yes.
Okay. But when we draw, if we remortgage to get access to the equity increase, then we get that equity out tax-free, but we're now paying higher rates of interest for it.
Yes.
But an LLP gives you a number of real good structural opportunities and tax opportunities which tick all of the compliance boxes. It's within the letter of the law and the spirit of the law. And excuse my clock, I should have stopped.
No, it's lovely to hear it. So, that sounds like the bongs of Big Ben saying, "Listen to Neil."
Yeah, but what can it save? Well, that in certain circumstances, and I don't want to go into too much detail, and I don't want to reveal personal numbers, but but if we think about the scenario that you're in, then the tax planning that we're doing for you quite legitimately will mean that all the properties that you own in your own name at a point in the not too distant future will all be revalued to today's prices with no capital gains tax and no SDLT implications.
Happy days.
Yes. It also means that you will always be never more than a 20% taxpayer.
Happy days.
And that you will be able to draw equity from your portfolio, from both your personal portfolio and your corporate portfolio, without any tax implication, because you're drawing your own equity. Okay, your companies will still pay corporation tax. Can't avoid that. Sorry about that. You will still pay personal tax. Sorry about that, but it will never be any more than 20%. But you can have a lifestyle that you want, and it's the structure that we've put together that is fully compliant, meets all of HMRC requirements. It's totally visible to HMRC. They can see exactly what's being done.
And I think this was a moment of lucidity, and more than just a light bulb going on. It was like a fireworks show when you explained this to me, Neil, because our tax situation was a little bit precarious in the sense that we were struggling should we say with section 24. Section 24 was, having a big impact on us, and we were looking for a way. So but having said that, that was a sort of secondary issue. The primary issue for me was inheritance. But then when you explained about the LLP structure and what that could do, that answers. I mean, and there's more, of course, which you haven't revealed tonight, but people can find out from you about the benefits of an LLP from the point of view inheritance, and beneficial interest in a property, and so on and so forth. These are all very, very powerful strategies and structures that are perfectly legal, totally compliant. HMRC is happy with them. You've got test cases, you've got situations, you've got studies that show that HMRC is happy, and yet for me it kind of answered so many questions, almost above and beyond the one that we had come to you for initially. But
that's and what you've said there is the bit that really annoys me, because you'd spoken to a number of other people who operate in this tax area.
Yes,
right. And they had mentioned to you LLPs.
Yes.
Right? They talked to you about incorporation, but they'd never really explained to you what you can do with these different vehicles.
Absolutely.
Right. So it wasn't a case of us sort of saying, well, look, here's some clever things that you can really, you can do, some really smart things. All we were doing was saying, look, there's nothing really clever about this. It's just very, very simple. All we're doing is using all of the rules that sit within these different types of vehicles that you can use. So, whether you do it in your own name, there's tax concessions with that, whether you do it, within an LLP, whether you do it within a limited company. But these are not standalone things. They're interconnected.
And you and your business partner Chris, who we had a number of consultations with, were the first people to have seen that and to put that together for us. Which is why we want to work with you. Surprise, surprise, because you can see the whole picture of somebody's taxable affairs, their estate, their thoughts about where their business is going. And yes, for some people, certain structures perhaps wouldn't be so relevant to them.
No, it's not. And this is really what you've got to understand the individual, and the tax planning has got to be built around the individual, the couple. That it's their portfolio, it's their life. And it's, well, what are you trying to achieve? In 5 years' time, in 7 years' time, where do you want to be? What do you want to be doing? What kind of income do you want? And because everybody's different. We're not we're not clones of each other. Things that you feel comfortable with, other people won't feel comfortable with. It's finding a solution that works for them. Some people are quite happy to pay a larger amount of tax, maybe for a very, very simple solution. Just, it might be that all they want is just solve that problem for me. That will give them all the options, but they're saying, no, we just want to do that bit. Okay, fine. We're quite happy for you just to do that bit, but you've made an informed decision. And that's what we see our role as. We've got to give you all of the information. We've got to give you all of the options, and then you can make an informed decision. You can say, well, I want, I don't like apples. I just want oranges and pears. All right. Somebody else will go, no, I just want oranges. But you've got to understand that there are oranges, apples, and pears available to you. And then you can, and that they do actually work together, and they can be combined to produce a solution. But now you've got all of that information, make an informed decision. We're not going to make any decision for you. Only you can decide which way you want to go.
Well, I think on that note, I'm going to put a challenge out to everybody that you must decide, having heard what Neil has elucidated this evening, you must decide what you want to do next. But in order to do that, we would love to find out, Neil, what the best way is for people to contact you. I will obviously put some links in the show notes below, your contact details. You've got a very good website, very easy to navigate. Property, let me just get it up so I've got the correct URL.
Propertytax360.co.uk.
Lovely. So if somebody is interested, having listened to what you said this evening, they can come through the website and contact you.
Yeah, there's a contact page on there, and they can just contact us, and we'll get back in touch with them.
Lovely. That's absolutely brilliant. Well, listen, I would like to say a very big thank you to you for your time this evening. It's been so interesting. I do think it is amazing. I have to say, this is something which I know lots of people might find incredibly boring and very dull, but because of the mechanism and what it can do and what it can achieve, I'm absolutely thrilled and excited about it. And I think it is such a wonderful result and a solution, I suppose, for many people who may have felt that, well, there's lots of different solutions. There isn't one solution, but all I can say from what being your client is that for us personally, I feel as if I can go, we've found a solution to Section 24, inheritance tax, growing the different businesses that we have, involving our children in our businesses, all of those other things which we kind of didn't really think were very important and probably wouldn't have really told you about to start with. But as we carried on with our conversations, you asked us about them. Well, how do you think, what do you think this time with the boys? And, and I shared some very different things about them. And you said, okay, so we could do it this way or we could do it that way. And suddenly you realize it's not a one size fits all. But when you it's a bit like I once had a suit tailored for me from India. And I had to send them all my vital statistics, and they tailored for me out of lovely blue, navy blue silk, a lovely suit. And when it came in the post, it was wrapped in brown paper and string, and it was all, beautifully presented. And I remember unwrapping this suit and trying it on, and it just fit me bob on. And to me, that's exactly what you and Chris do, is you provide a tailored solution.
Yeah, it's got to be a tailored solution. It's not off the peg.
No, absolutely. And that's what makes it different, and that's what makes it amazing, and that's what makes it awe-inspiring. And I really do believe that. And we're absolutely delighted to be working with you.
Excellent.
So thank you very much indeed for your time this evening, Neil. It's been informative and inspiring as ever, and I do hope that people can get in touch with you if they've got questions or queries. I know you're great at answering people's questions. I'm very willing to have some time with them if they want to just start opening that door to exploring what is possible for them.
That's not a problem. Happy to have a cup of coffee, a virtual coffee with anybody.
Fantastic.
Okay. Thanks,
Thanks,
Wendy.
Neil. Thank you.
Okay, cheers.
Thank you for listening to the HMO Success Podcast. If you'd like to know more about how you can create a profitable HMO business, please visit our website, hmosuccess.co.uk, to find out more. We have plenty of free tools and information for you there, and also on our Facebook group, The Ultimate HMO Success System. We look forward to connecting with you very soon. Thanks for listening.